Want to bring in Cumberland Advisors Chairman and Chief Investment Officer David Kotok and the Wall Street Journal's Chief Economics Correspondent John Hilsenrath. Good to see you both. Thank you so much for joining us. John, let me ask you first, how significant was that move in the dollar yesterday, and what did it tell us?
I think it's really important, and what it tells us is the market's view about the Fed is changing as we speak. You know, the Fed has been saying that they would do 4 interest rate increases this year. The market is now saying they might not do anything at all. And because they see the Fed shifting, they're taking that out on the dollar.
All right, so that's why the market rallied, David. Would you buy into this rally? What do you think in terms of the dollar going lower yesterday, and it is lower again this morning?
We bought into the rally. We're in this market. We think this market heads higher. I agree with John's assessment. Maybe 1 this year, certainly not 4. And the market realizes the Fed is not going to kill a struggling economy that's going to do maybe 200,000 jobs. They're not going to do it. They're smart enough to realize that you don't squash a weak recovery.
Well, we'll see what happens with the jobs number. 200,000 is the number to watch in terms of new jobs created. Some people, Joe, are as low as 195,000. So we have this very slow recovery that really is not showing much growth.
Yeah, exactly. In fact, some analysts are expecting 190,000 according to Thomson Reuters average. So we'll have to be watching what kind of jobs get created, and then also wage growth. Will we continue to see a small tick up, or maybe hopefully a significant tick up? And then labor force participation is what the number I always watch, because it continues to be at such multi-decade lows.
Hey, Maria, one point I'd like to throw in there.
Yeah.
You know, 190,000, even if we get that, that's a strong number. You know, this economy, because it's growing so slowly and because so many people have dropped out of the labor force, doesn't need to produce a lot of jobs to bring that unemployment rate down. You know, anything over 100,000 is going to be bringing the unemployment rate down, with all these retirees kind of moving out of the labor force right now.
You know, it's interesting to look at the Federal Reserve when you compare it to other central banks. The other big story for markets this week, of course, was the Bank of Japan going negative on interest rates. What are your thoughts there, David?
I think that is the most powerful force, Maria. We now have 5 currencies, 23 countries. 1/4 of the real output of the planet is housed in those 23 countries, and they are following a negative interest rate policy of some type. This is remarkable. It's bullish for financial assets.
Yeah.
Well, how much economic recovery remains to be seen.
Do you think it will work in terms of encouraging spending in Japan and getting people to actually take out loans and spend more money?
No, I don't think it'll work. I think it is an act of almost desperation. Central banks are out of traditional policies, but it suppresses interest rates worldwide, in the U.S. and everywhere else. And the effect of lower interest rates is to raise asset prices.
Well, I think, Joe, you bring up a good point, because the broad economy in Japan is still in recession. And we're seeing if there's anything that could actually move things in Japan. But at the same time, corporations are cash rich. And you're seeing pretty good earnings from the corporate sector.
That's true.
If I can add, the equity risk premium on Japanese stocks is 700 basis points over a 0 interest rate. That's double normal. We are overweight Japan, currency hedged. The Japan weight in the index is 17%. We're at 30. Currency hedged. Because it's such a bargain.
John, can the Federal Reserve raise interest rates when so many central banks around the world are cutting, and now we got, Japan negative?
Well, I mean, that's what the market is concluding this week, that no, it can't, and that's why we're seeing the dollar drop, and why we're seeing bond yields go below 2%. You know, I wanted to say one other point about negative interest rates. We look a lot at central banks for the explanation for this. What I see when I see interest rates going negative around the world is an insight into human psychology. People are so reluctant to put their capital to work right now that they're basically being paid to do it by the rest of the market. And I think that just tells us how skittish the world economy is right now about doing any kind of investment at all.
Yeah, Morgan.
I I want to take a little bit of a contrarian view here because I think that the fundamentals of the economy are quite strong, especially when you're looking at the jobs report. And John mentioned this earlier. The market has been wrong before, back in September, about whether the Fed would raise rates or not. Considering what their forecast is for 2016, I don't see how they go this entire year without raising rates. I don't know if that's what you're predicting. I know that we've had clearly a very bad January for the markets, worse since 2009. But I think with the fundamentals, the Main Street fundamentals are strong enough that I think the Fed's going to have to raise rates.
Maybe second half of the year?
Well, you know, I think this is what they're looking at, though. You know, if the job market keeps improving, if the unemployment rate keeps coming down, and Joe Ling mentioned this, if we start seeing some pickup in wages, they will move, and they're just going to have to live with the financial results that come from that. They always say they're data dependent. It always comes back to them to the jobs numbers and the inflation numbers. That's why tomorrow's report is going to get so much attention.
All right, we'll be watching. John Hilsenrath, David Kotok, good to see you both, gentlemen. Thank you.